Well, welcome everybody. I am delighted you are accessing this podcast today. It is recorded on June the 23rd, and we very much hope and expect that over the coming days and weeks, and indeed months ahead, you will be accessing this if you would like to get information on renewable investment development in Ireland. So this is the first time we've done a podcast specifically on renewable investment in Ireland. And I do think if you look at what is happening in the renewable investment world, the likelihood is there will be many more of these things coming in the future. I am delighted that we have with us today David Norton, who is a partner and head of investments at Byrne Wallace Shields. Also, Keith Parker, who's Managing Director, Business Development at Epic Investment Partners, and Michael Toohey, who's Partner and Head of Financial Services at Forvis Mazars. And for those who don't know me, my name is Simon Osborne. I am the CEO of IFI Global, which is a research and media house based in London. And we have a sustainable investment publication that covers renewable investing very closely indeed. I'm going to say a few words by way of introduction, and then we're going to get into a panel discussion. So by way of introduction, a bit of background. It is forecast by many people, including this forecast is specifically from the US Energy Information Administration, that half the world's energy will be from renewables by 2015. And that is relevant to this conversation that we're going to be having, because no matter how fast and substantial the increase has been over the last few years in renewable investing, we're still probably only at the foothills. We have an awful long way to go if that forecast by the US Energy Information Administration, and indeed by others, is going to be anywhere near accurate. Things are changing and moving very quickly. Last year, the ratio of clean energy investment to fossil fuel investment actually got for the first time to a 2-to-1 ratio, and that's from the IEA, which stands for the International Energy Agency. Quite a substantial change in such a short period of time. And as one looks forward into the future, one would expect the ratio to go even further, 3-to-1, potentially 4-to-1, 5-to-1, whatever it will be in the future. It's definitely only going to be going in one direction. And at the moment, we have just broken through, if you add in investment in not only into the actual solar panels or into the offshore wind farms, but with all the massive amount of infrastructure you need to put in besides that, we're now at a stage for the first time as well where $3 trillion is being invested in renewables, according to Bloomberg Net. That's one of the main stats that we have on renewable investing. However, they do make the point, and this is very relevant to the discussion we're about to have, is whilst 3 trillion sounds like a lot of money, it's nowhere near enough, says Bloomberg Net, to get to that goal of net zero by 2050. According to them, we need to go up to 3 times that amount per year to get to that amount. Whether we come anywhere near that, I don't know. But the point is, and this is relevant again for the discussion we're about to have, there's almost certainly going to be, I can't imagine in any world there won't be substantially more investment into renewables coming up in the next few years. The only question is how much more, whether it's just a little bit more or a huge amount more. And so I think we're really still at the very early days of what a remarkable transformation there has been. And I think the investment industry, coming on to the discussion we're about to have, is only beginning to understand the enormity of the issues involved in this. And that brings me to my final slide. At IFI Global, we in our publication, Sustainable Investment Intelligence, we track this stuff on a very regular basis. We've just in the current issue, the June issue, we've done this yet again, and we've done a comparison of 50 of the largest pension funds around the world, from Australia to America and everywhere in between. And when we did the same comparison last year, you would have found one or two of the pension funds we analysed that weren't in renewables. This year, every single one, literally every single one was. And perhaps the more interesting and surprising statistic is not so much that, but 69% of these pension funds have been increasing their allocations into the sustainable sectors in plural. It's not just enough that they're in there, they're putting more of their assets into various projects and schemes that come under the renewable banner. That's substantially more than any other sustainable asset class by a country mile. The nearest one to that would be biodiversity stroke nature, and I think the increase was something like 20% on last year. So that just shows you this really is a huge, I don't have the figure in front of me right now, but I would say it's very likely by far the largest change in institutional investment in the world going on at the moment is into sustainable, well, yes, it is sustainable, but particularly into renewables, whether it be particularly solar or wind. And again, to repeat what I just said, I don't think the investment industry has yet really cottoned on to the ramifications of this. And it's not just the pension funds, by the way. We do the same with sovereign wealth funds, with family offices, and it's the same applies to those investment categories as well. Having said that, what is interesting, perhaps slightly dismaying, at the same time as talking about this enormous boom in investment that we're going to be having, is that the public funds and the indexes that measure this stuff have not done well over the last 5 years or more now. I've just picked one out for this intro presentation, which is the S&P Global Clean Energy Index. It's down 14% over the last 3 years, which is interesting. And perhaps we might touch upon that later, why that is. So we're in this slightly unusual situation where everyone expects substantially more, a tsunami of further investment to come in, but the performance hasn't been that great. But people are doing it nonetheless. By the way, I should add, this is public funds and indexes I'm just mentioning here. And we talk quite a lot to private equity managers and managers in the private markets. Their performance is pretty much always substantially better than in the public areas. Finally, a last point I want to make before getting to the panel discussion is that no jurisdiction, whether it be the traditional fund jurisdictions or other ones like the UK, the US, or other ones across Europe, no jurisdiction has yet become the obvious home for renewable investment products. At IFI Global, in our publication Sustainable Investment Intelligence, we publish a list of pretty much all the renewable funds that there are, and we have the domiciles for, I think, just about all of them. And you see Ireland there, you see Luxembourg, you see the UK, you see the US, you see all the places you'd expect. And I would expect over the course of the next few years, one or more of those jurisdictions, hopefully it could be Ireland, will come to really be recognized as the place for renewables in the way perhaps hedge funds, you think Cayman or whatever it may be. There's several other examples one could pick. So that's the end of my introduction. I would like now to go to the panel and ask them perhaps what they have any comments on that, and then we'll get into the general chat. Let me remind you, we have David Norton, who's a partner at Byrne Wallace Shields here. We have Keith Parker, Managing Director at Epic Investment Partners, and Michael Toohey is a partner at Forvis Mazars. Gentlemen, do you want to make any quick general comments on what you've just heard, and then before we get into the general chat, or shall we go straight into that?
Let me if you don't mind, Simon, just as an extension of some of the statistics that you've specified, also citing Bloomberg NEF as a data source. Currently in Europe, the generation of electricity, approximately 30% right now in 2025 comes from renewable sources. That is projected to reach 72% by the year 2050, so 25 years hence. So that's a significant transition. But what's very interesting about that is that this energy transition is generating an enormous demand for battery storage. And the reason for that is renewable energy is an intermittent source, meaning let's say it comes from wind, which is not a stable source of energy like a fossil fuel would be. So as a consequence of that, of being intermittent, the battery storage opportunity is enormous. So citing the same source, the increments in the gigawatt production of electricity, currently at about 15 gigawatts, is expected to increase to 375 gigawatts by the year 2050, a 25-fold increase. So that as a subset of renewable infrastructure as an investment opportunity set, that on its own, and there are others, but that on its own, battery storage represents an enormous, as I say, opportunity as a subset of renewable infrastructure. So that's one component part of this emerging and rapidly increasing opportunity set.
Yeah, I mean, storage, you're absolutely right, is it's the Achilles heel of the whole renewable story because of what you've just said, being an intermittent source of energy. If they can solve or substantially reduce the problems with the intermittent nature of it through storage, we're in a completely different ballgame. And some of those projections I just gave you would probably accelerate substantially.
Absolutely. And then we've also got hydrogen, which is much touted as this golden source of energy. And, hydrogen is one of the few energy sources that doesn't generate any carbon dioxide as an emission. So that is something that is being very, very actively analyzed and worked over. So that's another subcomponent part of the renewable infrastructure. There's another one. You've got carbon capture, utilization, and sequestration. We've got renewable gas. So, it's not only battery storage. There are a number of sort of sub-verticals, if you like, within that composite renewables infrastructure, which represents an enormous investment opportunity and really hence the conversation we're having today.
Okay. I don't, Michael, David, do you want to say anything? Otherwise, we'll go into the nitty gritty, I think, of the discussion that we're planning to have.
Yeah, I think just to add in that context, Simon and Keith, thank you. Just taking a step back, in my day job forming funds in Ireland for global sale, I'm asked the question, well, what is a renewable? Just to take a step back, so renewable energy is energy derived from an unlimited natural resource that can be replenished at a higher rate than is consumed. So that's power derived from a natural source such as wind, such as the sea, such as hydrogen. And I think asset managers, when structuring, need to consider the fact that the US, France, Germany, the UK, and others need to make themselves self-sufficient in renewable energy over the medium term, thereby reducing exposure to fossil fuels. I think lessons can be learned from history on the damage caused by various oil shocks in the 70s, and of course, with current geopolitical climates being considered, there may well be further fossil fuel shocks during the remainder of 2025. So the idea of becoming self-sufficient in renewable energy is a sound idea.
Agreed.
Okay, well, can I put the spotlight back onto you, Keith, and ask you to perhaps outline what the expertise that there is in Ireland for conducting oversight of renewable funds. What does the Central Bank of Ireland require here? if you were to register your fund in Ireland? And generally, what is the expertise that you have for if you're a renewable manager watching this, say from the US? What would be the kind of service capability in the Irish market? And whilst you're doing that, if you wouldn't mind, again, particularly for the US market, just touching upon what a ManCo or an AIFM does, because for many people perhaps listening to this, it will be an unfamiliar concept to them.
Absolutely, with pleasure, Simon. So let me create a little bit of broad context just to make sense of the questions that you've asked. So essentially, in the EEA, which consists of 27 countries, and let me just call it the European Union for simplicity's sake, if you domicile a fund in any one of those countries, and let's speak specifically within the context of Ireland, they're effectively two different types of funds. So, and you've got what is called a UCITS fund, which is effectively, typically you could think of an equivalent as a mutual fund, a long-only fund, a very liquid fund, a fund that would be marketed to retail investors. And then if a fund is not a UCITS fund, and a UCITS is an acronym for an undertaking for collective investments in transferable securities, admittedly a little bit of a mouthful, but again, think of a liquid retail type structure. If a fund doesn't fit in the UCITS regulation, it is what is called an AIF, an alternative investment fund. So quite simply, that binary distinction is as simple as that. Either a fund fits into a UCITS structure or sits into an AIF structure. And certainly within the context of talking about renewables, these type of fund structures would typically be an alternative investment fund. Now, there are two pieces of regulation that apply to each of these fund structures. And the first one is the UCITS regulation, which applies to a UCITS fund. And second of all, you've got AIFMD, which applies to AIFs. UCITS regulation goes back to the mid-80s, largely as a function of the economic crash of 2008, 2009, led to the introduction of AIFMD regulation in 2013. And what the European Commission has been doing over the last number of years is to try and create a level playing field across these two different landscapes. And that convergence continues to take place. It's not there yet, but that level playing field has certainly emerged. But the flattening it, if you like, in terms of true convergence, continues. So if you decide to establish a fund in the EEA, and let's again, for the purpose of this discussion, establish a fund in Ireland, you need to appoint a management company. Typically, we call it a ManCo, which is just a portmanteau for management company. If you establish a UCITS fund, you need to appoint a UCITS management company. If you establish an AIF, you need to appoint an AIFM. For all intents and purposes, both entities have similar responsibilities. They are governed in Ireland by the Central Bank of Ireland, which is our national competent authority. There are equivalent national competent authorities across the EEA, and they all effectively fall under the auspices of ESMA, which is the supranational body that effectively regulates the region. So again, if we're talking to an audience of, let's say, a US-based manager that is interested in establishing a fund in Ireland that invests in renewable infrastructure, typically that fund would be an AIF. It doesn't have to be. It could be a UCITS, as I've said, but let's just say it is an AIF. That manager would either need to appoint a third-party AIFM, such as ourselves at Epic Investment Partners, or they could go down the route of establishing their own AIFM. But that is a different proposition entirely. They would need to hire staff, a considerable number of staff. And the reason for that is that the CBI takes the regulation of investment funds extremely seriously. So it's a highly, highly regulated environment. Now, there's a downside, if you like, in the sense that a regulated fund is expensive to run from a regulatory point of view, but that is easily offset by the enormous infrastructure, security, comfort, investor protection that comes with a highly regulated fund. So if Epic Investment Partners acts as a management company, whether it be a UCITS, AFIM, or both, the CBI looks to us to make sure that the ecosystem that sits around a fund, every one of those component parts of that ecosystem, whether it be the board of directors, whether it be the fund administrator, the depository, the MLRO, and so on, including ourselves, does everything we're supposed to do. So it's all about governance. So in the final analysis, when you distill it down to its essence, if you like, at the very foundation of what a management company or manco does is all about governance, ultimately to preserve the integrity of the superstructure of the industry and ultimately, and by extension, investor protection. If the investor, whether it be a retail investor, an institutional investor, is protected, and in his or her or their interests are always considered, then again, to use my word again, the integrity of the superstructure holds. And that is evidenced by the enormous success of the funds industry in Ireland in particular. We've got 6 trillion euros worth of assets that are administered in Ireland, which is a remarkable quantum. And renewables effectively is another component part of the entire universe of the opportunity set of where money can be allocated. So the CBI doesn't specifically speak about renewables being treated any different from any other type of regulatory oversight. That particular regulatory oversight is agnostic, if you like, to the underlying investment strategy and asset classes. But certainly a fund investing in renewables, in this renewable infrastructure we're talking about, would have to meet the very, very, very high standards that the CBI effectively asks all of those participants in the ecosystem around an investment fund to abide by. I'll stop there. I've spoken a lot, but hopefully that will is given the audience a good idea contextually what that all looks like.
David or Michael, do you have any comments on that before we move into other areas?
I'd agree with Keith. I mean, it's no different really to any other real assets type of fund. So, I mean, to compare it with a real estate fund, and Ireland's obviously is a big home of real estate alternative investment funds. There is no difference from a CBI expectations on how an investment manager would manage a renewable asset fund versus something like a real estate fund or any other real asset fund.
Yeah. I think Keith and Michael are correct. I think if you're a US manager sitting in Boston or New York, a first question to probably ask is, why Ireland? Well, Ireland is the fastest growing European fund domicile. It houses over 20% of all European fund assets, Simon. And in 2024, as Keith alluded to, Ireland domiciled investment funds have reached over 6 trillion in assets with, and this is key for a US manager, with over 400 billion in net sales in 2024. So a further question you can ask is, why are there 296 US managers with investment funds domiciled in Ireland? And the principal reason is because European investors want them to be in Ireland. They want the US manager to structure an Ireland regulated investment fund for sale in the EU. And who are these European investors? They're pension funds, they're sovereign wealth funds, they're insurance companies, and they, in particular, Simon, Michael, and Keith, prioritize regulated institutional quality structures to invest in, and structures which are domiciled in reputable jurisdictions such as Ireland.
Yeah, I knew there was obviously a very strong connection between the US and the Irish market, and indeed the UK one and the Irish market too. But I didn't realize it was 296 US managers. That's an interesting figure. Against knocking on the door of 300. That's pretty impressive.
And wait for it, Simon. The news gets better for a UK manager. There are 359 UK asset managers with funds domiciled in Ireland for global sale. So the reality is we are fully open for business investment catering to the needs of a US manager and a UK manager that's structuring a high quality regulated investment fund in Ireland for allocations to renewables on behalf of really blue chip investors.
And same with you, David. Can we move on to something? If you could tell us something about the different legal structures that those, not just those 296 US managers and 300 and whatever it is, UK managers, but anybody and everybody who's coming to Ireland, what are the structures that they're using, particularly if you could touch upon what they're doing in sustainability and especially renewables. And so if you talk to us, Keith mentioned the origins of UCITS just back then and the AIFM directive and all that good stuff. But also, if you could mention, without boring everyone to tears with the SFDR categorization malarkey, that you could probably keep us going till midnight talking about if you wanted to. But over to you, David.
Simon, thank you for the opportunity to answer those very interesting questions. The reality is, Keith is once again correct in the context of the two regulated investment structures that you can allocate to in Ireland. I think with the time I have remaining, I will take them in turn. So first of all, we have our UCITS. That is designed with the retail consumer in mind, ensuring an appropriate level of protection for that profile of investor. The common aspect of the UCITS, Simon, is that it must be open-ended and liquid. Now, in that context, how can a UCITS gain exposure to renewables? Well, actually, there are a number of ways. First of all, it could allocate or invest in a publicly traded renewable energy company, for example, Ørsted or NL Green Power. It can invest in green bonds that are issued to support and finance renewable projects. It could allocate to an infrastructure ETF or another UCITS fund, which is focused on clean energy. It could allocate to a renewable energy REIT if it is listed and liquid. I think in the context of the UCITS, it should be borne in mind that a UCITS can't invest in renewables in the following investment context. First, a direct investment in a physical infrastructure project, for example, a wind farm in Norway or a solar park outside Madrid, unless they're listed companies. If they're illiquid securities, noting you probably do want to go above 10% allocation, it is going to be helpful to use the UCITS product for that investment. Likewise, a private equity style investment in an early stage renewable startup is probably not going to be the home for your UCITS allocation or an unlisted or illiquid renewable asset, because there are strict diversification requirements for those types of allocations for the benefit of the retail investor. So that's why a lot of the US and UK managers and other managers listening to this podcast, which again kindly has been structured by IFI Global through the custodianship of Simon here before us, and which is much appreciated, is the QUAIF, the Qualifying Investor Alternative Investment Fund. Again, that is highly regulated and more suitable for a well-informed and professional investor. The reason why it might be more interesting to structure a QUAIF in Ireland is because there are broader investment powers, less investment restrictions, and also a very speedy approval process, 24 hours to get authorised in Ireland. Of course, there is the lead-in time of agreeing the offering documentation and the material contracts. But as a result, the Qualifying Investor Alternative Investment Fund can access or invest in direct renewable infrastructure projects, unlisted equities in renewable developers, greenfield and brownfield energy assets, debt instruments that are financing renewable projects, purchase power agreements, for example, and then the suite of derivatives and structured products that are tied to energy prices or carbon markets. So as a result, when the US or UK or other managers thinking about which structure to use, the UCITS or the QUAIF, you're thinking about the investor, you're thinking about what you're investing in, and you're making your decision accordingly. So they're the material differences between the UCITS and the QUAIF in terms of the legal structures. And as you said, Simon, not wanting to bore your audience too much, but the legal structure is important. You can use 5 legal structures to house your quaif, you can use 4 legal structures to house your UCITS. In terms of the most popular structures that we're seeing in the market in 2025, it's probably, if you're looking for a corporate fund, it's the Irish Collective Asset Management Vehicle, or ICAV, and we're also seeing an uptick in popularity on the partnership. So the use of the legal partnership to house a quaif, noting that partnership structure is not available to house a UCITS. And then finally, before I pass back to you, Simon, just to very briefly mention the SFDR. So for a US manager, oh good Lord, another acronym, what does that mean? So that is the Sustainable Finance Disclosure Regulation. And pursuant to that piece of legislation, there's an obligation on a manager to classify a regulated investment fund across 3 grades. Is it Article 6, which would be a non-sustainable investment fund, which is unlikely to be a classification you choose if you're allocating or investing in renewables? So you're then left with 2 choices. One, an Article 8 fund, where you do promote environmental or social characteristics, albeit it isn't core to the reason why you've structured your fund. And that might be your classification for your renewable fund. And that is, in simple terms, what we would term a light green fund. Your alternative choice then is your Article 9 fund, and that is where you do have sustainable investment as your core objective, which may again well be your renewable fund. If you're structuring a quaif in Ireland, you're going to be allocating 100% to renewables in Scandinavia for the benefit of a German sovereign wealth fund. You may well be classifying that structure as an Article 9 fund, and that's what we would label as a dark green fund. So Simon, hopefully in simple terms, that's unpacked a little bit about, first of all, the regulated investment funds that are available in Ireland, the related legal structures that you can use, and how you might classify each of your fund structures from an SFDR perspective.
Either Michael or Keith, do you want to comment on that? Before you ask anything, I just want to know one thing, David, is are you seeing a trend in any particular direction in terms of sustainable funds and particularly renewables in Ireland? In what type of structures they're using? Is there a more common path than others?
Well, that's a really good question, Simon. I think the reality is when we think about Ireland, we're thinking about the structure for global investment. Sure, certain allocations are made to renewable projects in Ireland, but a real trend I'm seeing is how we solve for cooling and clean tech in Southern Europe, noting the rise in temperatures and the cost involved in cooling mechanisms for the benefit of manufacturing, for trade, for hospitality, and how renewables can be harnessed to make that process more efficient. That is a particular trend we're seeing, Simon. There are others as well, but ultimately it comes back to the point I made at the start of our podcast together. It is, how do countries solve for fossil fuels being something that have a finite resource, and how do we harness renewables, which does not have a finite resource, as a substitution.
Thank you.
Simon, I've got a couple of comments to that, but I'd just like to give Michael an opportunity to perhaps comment.
Yeah, no, thanks, Keith. I just agree with everything David has said. And I know we'll get to it when we talk about the accounting issues, but in your investment through your fund, and absolutely when it's a direct investment, it is through an AIF. But then I suppose the other thing for managers to consider is how that AIF invests right through to the underlying asset. And again, we have a very, very good legal structure in Ireland. It's called the Section 110, so it's through a purpose vehicle. So it does allow investors to invest through an SPV with very, very good tax rules, and allow you to have full protection of your asset within that separate legal entity. So a Section 110 or an SPV, I know from the funds that we would audit, we would typically see your investment through the AIF, but the AIF is taking either direct investments in SPVs or are in the holding company, and the holding company has a number of SPV subsidiaries below it, depending on the exposure they want, to diversify to the entire portfolio of SPVs and different assets. So again, that's a very, very tried and trusted legal structure as well that sits under the regulated AIF structure.
Yeah, I'm glad you've mentioned that, Michael, that SPV is an important consideration again in that ecosystem. Yeah. Simon, just back to David's comments around SFDR, movements of monies into the Articles 8 and 9 funds. For people listening to this podcast or watching this podcast that are not domiciled in Europe, or indeed are in Europe but don't know this, is the question, I suppose, are all these developments being wholly market driven? No, the answer to that is there's a big political dimension to this energy transition. And what I mean by that is the European Union's Sustainability Action Plan, which was deployed in 2018, is, I suppose you could argue, within the context of the EU or the EEA, is the superstructure that drives all these underlying moving parts. So the European Union and the European Commission heavily politically committed to this energy transition that we've been speaking about today. And then just looking at some of that, what that means within the context of Articles 8 and 9 funds that David mentioned, Article 8 being euphemistically called a light green and then dark green in the case of Article 9. According to ESMA, when SFDR was introduced in early 2021, there were 3.7 trillion euros invested in Article 8 funds. That has increased to 9 trillion as of the end of 2024. So that's a considerable increment. Article 9 has been a fairly stable asset quantum sitting in Article 9 funds. And one of the main reasons for that is the requirements to be qualified as an Article 9 fund are very, very stringent. But that considerable shift from 6 into Article 8 is strong evidence of the attractiveness of Articles 8 and 9 funds, which effectively are all predicated on sustainability and the reorientation of capital into sustainability, which ultimately comes back to today's discussion around renewable infrastructure as investment opportunities.
Yeah, and it's worth making the point, and to back up to what you've just said there, Keith, when I mentioned earlier, we do a lot of analysis in sustainable investment intelligence on where the allocations are coming. The European pension funds, there are many honourable exceptions in the States to this, and particularly the CalPERS and the CalSTRs and the really big, huge, well-known pension funds are exceptions. But the whole market in Europe, right from the top down, is more advanced in terms of sustainable investing, especially including renewables, than it is in the States and other parts of the world. And therefore, I think what we've just been talking about in terms of the legal structures inevitably, I guess, follows from that. So if you're an American manager listening to this, looking at this, you're thinking, if you really want to be in the part of the world where the expertise is, this is the place to come. And without wishing to get into the politics of this, the current Trump administration is none too keen on renewables, but this part of the world very much is keen on it. And you mentioned the plan that the EU put into place X number of years ago, and that's only going to go in one direction from now on, and there's not going to be any changes to that in the foreseeable future, and probably not indeed within our lifetime. So anyway, can I please now turn to Michael and ask him about the accounting considerations that apply for renewable funds in Ireland, and particularly how assets are valued, how are they disclosed, and what are the requirements that a US manager has to be aware of and contend with? Because as we talked about on our prep call, Michael, I believe they're somewhat different from what a US manager domestically will be used to.
Yes, somewhat, Simon, but then again, a lot of similarities as well, that US managers, and particularly the finance function teams of US managers will be well used to. I suppose not to focus on the UCITS piece, because as David has said, you're with a UCIT investment, there really is no accounting difference, whether it's any type of equity investment. So the fact that it's renewable doesn't really make a difference. So if we're talking about really, I suppose, direct investing in real assets and using the alternative investment fund structure, I suppose the one key point to make is that in Ireland, you really only have two choices of accounting frameworks. So you cannot apply US GAAP. You're left with international financial reporting standards or local standards, FRS 102, and those two have really converged to be pretty much identical over the course of the last decade or so. There are some differences still with US GAAP, but I think it kind of looks and feels more from a presentation perspective in your financial statements and from a disclosure perspective. So from, I suppose, the biggest talking points really from an AIF fund, again, it is really revenue and valuation are the biggest talking points. So from the fund perspective itself, it's relatively straightforward. So, if you are an alternative investment fund taking an equity investment in a renewable project, that renewable project is going to feed dividends up, hopefully, if it's successful. And the accounting for that is generally quite straightforward. If it's an AIF, that's a credit fund, so it's getting involved more in the development phase of the project. I suppose that, again, the key accounting implications there at a fund level is going to be, particularly around a credit fund, it's going to be you'll be holding your asset at amortized cost, but really building your models that allows you to make provisions for any expected credit losses. So accounting standards in Ireland are quite strict on that if you lend on day one, accounting standards now require you to build an expectation of what you see are any potential future expected credit losses. So there's a lot of work that goes into the modeling of that. I suppose where it gets a little bit more complicated is at the underlying level. So your fund, I said it earlier on, invests typically in renewable assets, so direct investments, usually through that special purpose vehicle. So through the special purpose vehicle, you then get into more complicated areas of revenue recognition, because it's at the SPV level that is holding the asset and dealing directly with the counterparty to that asset. So the tenant, if you like, on the renewables. So again, there are quite strict accounting rules about, particularly when it comes to revenue recognition. IFRS 15 is really the standard that deals with revenue recognition, and it's all about the fund meeting its performance obligations, doing the work necessary of providing the service in order to earn its revenue. Now, there has been a big project to align revenue recognition rules under IFRS 15 and US GAAP as well. So really, I would say that those two have become quite aligned, although that from a presentation point of view, we do use different terminologies than from a US GAAP. The biggest piece then outside of revenue is going to be on when we talk about revenue recognitions, so I think was it David mentioned it, all of the discussions, and they can get quite complicated, if you have power purchase agreements, is it a virtual power purchase agreement, getting into are you investing in real energy, or are you taking more an exposure to an index? Do you have derivatives in your fund? But again, all those discussions are also had at a US GAAP level. So if you're in a Cayman fund, you still have to deal with those complications of revenue recognition rules when it comes to PPAs or VPPAs. Okay, and US GAAP reporters, they will know that concept well. So the valuation for sure is the complexity, and really it's, I suppose, if you were at the development phase of a project, your model is everything. So when you build your model, if the cash flows fall apart, then the whole thing falls apart, and it's pretty much the same way from a valuation perspective, because at the fund level, auditors like myself will always look through the fund right back to the underlying asset. You take out the SPV, and you're really, I suppose, looking at that valuation. So it's they have to be valued at fair value. There's no avoiding that. There's probably more cases in the US where you can avoid fair value, but really IFRS does require fair value. So the most common form of valuation for your renewable asset is based on the cash flows, and that's run through your DCF, so your discounted cash flow methodology. So it's all about the projections, the projections around the revenue. So if it's if it's solar or electric, it's looking at the future revenue projections modeled over a period of time. It's looking and challenging all the key assumptions around operating costs. If there's debt applied at the fund, looking at different assumptions around covenants, compliance, discount rates, I suppose the repayment schedules, all of that. So there is a lot of assumptions that are built into a model, and some managers will do that themselves, and that they'll have the expertise in-house to build that valuation model, that DCF model, or they will use a number of recognized third parties in the market who will independently provide that DCF valuation using all the assumptions provided by the investment manager. From an audit perspective, it's obviously more complicated than auditing a long-only UCITS equity fund, because these assets, these we would typically refer to these assets as level 3 assets. So when you talk about fair value, the best form of fair value is a listed equity. There's very little risk to it. It's very easy to determine the valuation. So that's level 1. When you're using a model valuation, like a discounted cash flow methodology, typically you would see these as level 3. So because they're a level 3 asset, it does then require more disclosure in the accounts. You're making it clear to the reader of the accounts that this is a level 3 fair value valuation, different to a level 1, and you try to give as much disclosure around the key assumptions that management have used in building that model. And I suppose within those assumptions, what would the manager see as assumptions that are directly observable in the market, are assumptions that really are less observable. So it's about trying to give the reader of the financial statements all that information when it comes to trying to really understand the basis of that valuation. So, really is revenue and valuation as the two key areas of accounting focus. On SFTR and I suppose on disclosures around Article 8 and Article 9, there are disclosures as well that you have to give on an annual basis in your financial statements. But I suppose we have been dealing with those disclosures now for the last, I think I'm going to say 3 years, guys, at this point of view. So I suppose there's expectations built in the market in terms of what are acceptable disclosures. And it's probably one other point to make is that those disclosures in your financial statements are actually unaudited, and they're called out as unaudited. So you probably don't have as much challenge from your auditors on those disclosures. They're more reading them from a consistency point of view as opposed to delving into the accuracy of those disclosures. So that's probably the key points I'd make, Simon, in respect to accounting issues.
And I think I'm right in saying, please correct me if I'm wrong here, Michael, that a lot of these offshore wind farms and indeed the solar parks are a series of quite complex, at least to an outsider, SPVs. That's how they're structured. You alluded to the SPVs in what you were just saying. That must present to you and your colleagues a number of accounting challenges. I know this topic from independent fund directors, and I know some sustainable managers are having trouble finding independent directors who've got the technical skills to add anything useful at the board meetings or even understand the reports that they're getting. Has any of you got any comments on that?
Yeah, I mean, they can be. Look, it can be quite complicated. It all depends. So you could have a fund that, typically what we see is that all the fund invests through SPVs. They don't hold the assets directly on their balance sheet, because they could have an investment in 10 different SPVs. You could have different investors attached to each SPV. You might want to just put single assets into single SPVs. But look, it's tried and trusted from a Manco perspective in terms of managing those SPVs and a legal perspective. So not too complicated in their establishment. But yeah, I mean, you can have quite a big Venn diagram or a spider's diagram when it comes to looking at some of these structures where you have multi assets and multi investors.
Okay. Do you, David or Keith, have you got any comments on the accounting disclosure valuation side? Before I ask my killer final question to you all, but you haven't had a chance to prepare for deliberately. But before we get to
No,
that,
nothing.
have you got anything you want to add to what Michael's been talking about?
No, nothing from my side vis-a-vis Michael's comments. Michael went into a lot of detail on the granularity of the considerations, which I think is excellent. But no, nothing more from my side on that side of the topic.
Okay. Well, in which case I'll finish with my killer question to all three of you. Perhaps we should come to David first, because you haven't spoken for the longest. And I just wanted you to give here we are in the middle of the summer of the year 2025. Where do you think the Irish funds market will be vis-a-vis renewable investing over the next 3 to 5 years? Do you think it will become potentially one of the dominant jurisdictions for renewable investing? If so, why? And what do you anticipate, looking into your crystal ball, that's going to happen? Same question is coming to both you, Keith, and Michael.
That's an excellent question, Simon. I think that's a question which is very relevant to a global asset manager. I think the reality is, when you take a step back and you think about policymakers globally and what their ambition is, referencing, for example, the Draghi report from summer of 2024, where the ambition in that report is that private capital is harnessed for public renewable projects because tax revenue can't do it all. So there's a public policy initiative here, which is a real tailwind for a US manager, because the fundraising opportunity is clear. There is a real and present fundraising opportunity for a US manager to structure a regulated investment fund in Ireland, which will then allocate to public and private renewables projects across Europe and wider afield. I think there's 5 key points, Simon, I would make in that context. First, choosing the right structure does take expertise. Now, you listened attentively to Keith and Michael. They made it sound easy. They're experts in their field, and expertise is required. My anticipation is, over the next 3 to 5 years, you'll see more use of the corporate fund in the context of the legal structure of an ICAV, and the partnership structure to house a quaif, which will then be the vehicles of choice to invest in renewables. I think the beauty of the quaif in either legal structure form is its flexibility. There are differences in that structure from a Delaware or Cayman equivalent, so it is very important for the US manager to understand these differences. And, for example, the requirement to have a depository appointed to safekeep the assets of either structure. So that's point number 1. Point number 2 is, as Keith alluded to earlier, most US managers will be unfamiliar with the requirement to appoint a EU authorized third-party AIFM to manage the assets of the fund in Ireland. This appointment does simplify regulatory compliance for the US manager, and a key point is appointing a EU authorized AIFM give you access to the marketing passport of that AIFM, so that you can speak to that pension fund in Berlin or that sovereign wealth fund in Stockholm. That is key. How do I go to speak to these institutional investors across the EU? Via the AIFM that I hire. The other point, and in that context, is to note, and sometimes this can be confusing for the US manager, that Europe is not one market, but many markets. So it is really important on this journey of fundraising that the manager thinks about distribution, thinks about placement agents, and thinks about how they get that tin of beans, which is the fund, off the shelf, and into the market, because there are regional nuances in each of the member states of the EU that do need to be considered. And then finally, two quick points. One, the regulatory framework in Europe is complex. I know we are attempting to demystify during the few minutes that we have together on this podcast, but there is complexity here. There is decisions to be made. Am I Article 8? Am I Article 9? What is that going to do to my structure? How will that influence Michael's view as an auditor on the accounts and other expectations of the regulation in Europe? So there is complexity, and getting early advice is very important. And then finally, to note that each of these structures needs a specialized administrator. Selecting a fund administrator with strong expertise in Europe and then in renewables is, in my view, critical, because that is one of the key relationships in the structure, having that strong administrator, that strong AFM, the strong audit team behind you, in addition to your legal support. They all come as a package, but in particular, the administrator understanding the performance water flow calculations, getting the valuations right in conjunction with the auditor, ensuring that the investor reporting is delivered accurately and on time, all crucial considerations when the US manager considers starting a journey of investment into renewables in Europe via their investment fund structure domiciled in Ireland.
Thank you. Michael, can I quickly come to you next and leave the last word with the event organizer of EPIC? So
again, I think David summarized it all very, very well, and agree with all the points he's making. I suppose the key takeaways to me in terms of when we're listening to David, he's 100% right. But you asked Simon about projections for Ireland. I have to think we're very, very confident, because we have a huge funds ecosystem in Ireland. We have the legal structures that David has talked about, and Keith as well. We have those big, huge fund admin houses that are in Ireland for the last 50, 60, 70 years. So we have a huge funds ecosystem. The other key point to make is that we talk about private assets. Renewables, for the most part, will be held through private assets. It's a huge focus of the Irish Inc. to grow our share of the private assets funds market. So we have obviously huge number of UK and US managers, as David had said, but really we want to see that growing. And I think we have all sectors of the industry. I mean, that comes up in multiple discussions. We do more in private asset space. So I think the energy and commitment is there, the structures are there. So I'd be very confident that we will see private assets and investments through renewables grow over the next 3 to 5 year period. That's my own personal view anyway. I don't know, Keith, what do you think?
Yeah, I agree completely, Michael. Those macro drivers that I've spoken about already, the EU sustainability plan, there's that strong political motivation, that strong political support across the EU. Then you've got, of course, the enormous increment over the last number of years in investments in private assets. Renewable infrastructure is really a subset of that. We've got a search for yield as a continued form of economic activity. So I agree there's going to be considerable flows into renewable infrastructure. Those are going to sit in SPVs and regulated funds. I only see more of those monies then being ultimately domiciled in Ireland as a domicile for those investment funds and SPVs. And then I think also really just to finish off from my side is you've also got sort of optically Ireland as a country itself takes sustainability very seriously. An example, at the end of 2024, an Irish sovereign development fund called the Ireland Strategic Investment Fund invested €100 million in a new private markets funds in collaboration with Schroders Greencoat. And this is all to ultimately be invested in renewable infrastructure across Ireland, but across Europe, but in Ireland in particular. And also, if you come to Ireland, you'll see many wind farms as an example. So optically, politically, Ireland as a country, we take sustainability very seriously. So I think the intersection of the optics that I've mentioned, coupled with all these macro drivers, and this strongly emerging asset class, namely renewable infrastructure, it really just has win-win outcomes for all participants. So I'm very bullish about what 4 or 5 years hence looks like.
Brilliant. Well, thank you all, gentlemen, very much indeed. Thank you, Michael, David, Keith, and also thank you to Epic for coming up with the idea of doing this. It's been really good fun.
No, it's wonderful. Thank you, Simon and David and Michael. Great working with you guys as always. So thank you from my side. Much appreciated.
Yeah, thank you guys for the invite.